Looking back here, there's no inefficiency until we get right there on this candle. That's the only inefficiency on that time frame. Okay, this being the 5-minute chart on the right. Because if you keep going up, there's really nothing in here to speak of in terms of inefficiencies. Now, you do have all of these consecutive up-close candles, which makes that a what? An ICT bearish order block. These up-close candles, if you take the body or the opening price of that lowest one and draw that out, looking at this, we talked about the very fair value gap right there. It's a premium array. What makes it a premium array? Well, the fact that we returned back up into it here, what was the range prior to that? What was the dealing range? This high, okay, so that's the high end of the dealing range, and the low of the dealing range prior to that return to that fair value gap right there is that low right here. So that's your dealing range. So what the algorithm does, it takes that range. How does it determine that range, ICT? If this is really an algorithm, how do you determine what a dealing range is? Well, first of all, you have to determine what your directional bias is, because if you don't have a directional bias, you don't have a dealing range. You're just using randomness. I see this old low over here on the daily chart. That's my personal interest. I'm accepting the fact that I can be wrong, because this week has already demolished and went way beyond my objectives for the week. In fact, everything I was looking for this week, it happened just on Monday alone. So it was a very overzealous Monday. And that's characteristic of what? We had CPI and PPI, and those are huge market drivers. And if they're occurring later in the week, Wednesday, midweek, if you're expecting a big move, if it doesn't happen by Wednesday, then you anticipate the latter part of the week to be big candles. But because we had CPI and PPI, those are introducing many times what? Large range candles, lots of volatility, big movement. If there's going to be an FOMC event, in the week, that means usually the beginning of the week will probably be really nice. And then you can get your nice setups there. So anyway, the dealing range high here, what makes this a dealing range high? Well, we're moving from this low all the way up here into this inefficient. I'm going to have to drag this down a little bit, sorry. All these inefficiencies here, this one, we're trading up into that. This candle's high, 17,724 even. And what does that say? 17,724 and a half. That's all it takes, folks. It has to clear a high to do what? To engage opposing liquidity. When you have that, if you're bearish, you want to see does it displace lower. Displacement is movement one-sided and heavy, in this case because we're bearish. If it was moving higher, it would be steady and consistently moving higher. This bump above that high, once it starts making lower lows, we're aiming for this to be swept. It does. Now, to get in sync post 8:30 news release, we go back through that range. That high is the highest high of the dealing range. That low is the low of the dealing range. Why? Because we've taken the buy side here and we've taken sell side. So it has engaged what? Both sides of the market, short term. What time frame? The 5-minute. Why 5-minute ICT? If you're looking at high impact news driver days, at the time of the release, minimum 15 minutes, you can't be underneath a 5-minute chart. Otherwise, you're going to get beat up with the spottiness and price action. 30 minutes for good measure. It's designed to run wider than you're probably going to expect it to seek liquidity. But when we have both sides of the marketplace swept, we have it here, there, and that low's taken. So what has the market done? First, what has it done? It has bumped the buy side. Does it displace? Yes. Is it able to take out the low? Yes. So what is this? This is many things here. You're going to discover how all my concepts overlap. And the strongest setups are going to be the ones that you can see have multiple reasons why it should do one thing and not the other. Meaning, this low being taken out, remember the bias is bearish. I don't need it to trade down to this daily low. I just need it to be able to move in that direction. Now think, if my bias is bearish, do I sell short on a break below that old low down here? No. I want to see the market come right back up into the range. Why? What is that doing? Well, let's see. That's model 2022, high, low, retrace. Here's 50%. Is the fair value gap above the 50% or at it? Well, here it is. That means it's a premium array. Okay, so here's the 62% retracement level, and here's the 70.5. Why 70.5? Because that's the sweet spot. You can use the 79% retracement level, but if you're demanding that or just below it as your entry, you're going to miss a whole lot of sweet trades. So you want to know what that 79% retracement level is, because then you want to look just above that. Okay, that's the 79% retracement level. So this is the optimal trade entry area here. 70.5, that's my high watermark for shorts. If I can squeeze something in at that price level, I'm going to try to do it. but 62% retracement level is about as good as I need it to be. And I'm going to have most of my limit orders if I'm trying to sell short in a short that is optimal trade entry and my bias is there and it's a lot of things going for it. I could enter right at 60% retracement level and then I'll layer additional limit orders. They may not fill. If the market starts to move in my favor, I'll just close the existing limit orders. But ranges and understanding the range and the liquidity and why the market should reach to a specific level or in a direction, that's where 99% of your focus should be. Always, all of your focus and time and analysis should be spent on that weekly, daily chart. Why should it behave a certain way on those two time frames? Keep referring back to it. Is it still showing you things that would warrant you trusting your initial analysis? Is it really trying to still reach for that objective as you outlined on the weekly chart? Is it really trying to reach for that objective as you outlined on your daily chart? And as long as those two things remain true, you should never fear holding on to the trade. So the fair value gap is above the 50%. So that means what? That's a premium array. And then the trade can be taken where shorting here or trading into the 62, the 79% retracement level inside that area. And I've already told you the 70.5 level, that's that sweet spot. Okay. So I'm trying to get that price if I'm using optimal trade entry or just below it. And I'm layering limit orders in if I'm going short at the 62% retracement level to the 70.5. I am not trying to get the 70.5 level because many times if you go back and look at your old data, you'll see that it just touches 70.5. And will that fill you? No, because you need the spread. So the dealing range is, this is how you define it now. Listen, this is for your notes. A dealing range is a high that has engaged buy side and a low that has engaged sell side. So now you've expanded outside the realm of the nearby close proximity liquidity. A dealing range is not a dealing range unless it takes both sides of liquidity, period. End of story. And it must be on the time frame you're looking for in terms of the analysis. So hello, have you noticed that we're talking about that 5-minute chart? The dealing range high and the dealing range low, we have to then see what? Where's the market going? What's it reaching for? You have to have something in terms of a longer term bias. Just know that that 697.5 level, that's the midpoint between the dealing range high and the dealing range low. And we would anticipate a break below that low later on. But that has to happen after. Now, that fair value gap is above the equilibrium price point, which is the midpoint between a range high and a range low. A gap or inefficiency is always going to be measuring the middle point, and we'll call that consequent encroachment. Now, why did I name it consequent encroachment? Well, it's consequential to what you're expecting in price action for it to reach up into the midpoint of that inefficiency. And where's it encroaching to? The midpoint. Many times you'll see it trade and reprice to the midpoint of a gap or inefficiency and fail to go any higher. Why? Because if it stays open, that is a breakaway gap. You want every time when you're trading an inefficiency, you want to see that other half of the extreme of the range that creates that inefficiency or that fair value gap. You want to see it stay open. At 8:30, right here, it's going to go up into that equilibrium price point here and seek a premium array. If you're bearish, you want to time Judas swings formation. 8:30, the news drivers are coming out right here. The market opens on that candle, trades down initially, sweeps that low. Okay, that's wonderful. Now we have done what? We engaged sell side. So now we have our range. It's defined now. So we can drop our fib here up to that high. We're bearish, so we want to see a Judas swing. There's a lot of folks who are going to see that low here, and they're going to want to buy it. Because why? They think that that's support. And they're going to do what? Get burned. You want to see a Judas swing, which is opposed to the direction you think the market's going to go. We want to see it trade lower. It does. But then what happens? It trades lower, takes that low out. So now we have a break in market structure. So inside of all this price action that would frustrate you, why is this marking time like that? What is it doing? I want you to look at the bodies of the candles in here. You see that? These are this whole section of price action. If we look at that here, and that's your lowest body in here, all this consolidation right in there. If we take that and we go into a 1-minute chart, what's going on? It's not moving, but it should. Remember, it should be moving lower. But why isn't it moving lower? It's waiting for something. What's it waiting for? 9:30 opening bell. So all of this right here is time distortion. That means you have to submit to where you entered, where your initial stop loss would be. But all of this in here, because of the waiting element that needs to be worked through, okay, we had 8:30 news driver here. We went up to the premium array, swept it one more time. They bumped the high here. So now the market should go where? Lower. But it goes lower just to take out the low, and then it's chopping back and forth. So what we would look for, that low and that low. You see that? The market drops below it here. We don't need it to trade below that yet. It's already done that here. Everything is geared for it to break lower. Every time after that stop run right there, every high was lower. Lower than that one, lower than that one, lower than that one, lower than that one. See that? So all it's doing is giving a signal to smart money that everything's the way it's supposed to be, and every single time we're inside this range in here, they're adding more to their shorts. But watch what it does. It does break below these lows here on that candlestick, and then the market trades back up into a bearish order block. This candle and that candle together, that is an area where inside that range, if the market can touch that area once more, treat it like the same way as trading into a fair value gap, like what I showed you on the 5-minute chart up here, that you're entering in there. This range right here, that's them getting in the last bit of opportunity in terms of timing where they can go short. So these up close candles, I don't really need that second one because now I can see that this one is shorter than that one. So this is the order block because this is inside the range of the previous up close candle. What is an order block? It's the change in the state of liquidity. Okay, it's where you are in the marketplace and how it changes its delivery, where it pinpoints a very specific time. It's specific in elements that provide you a very unambiguous range in price, where if it can trade to it, think of it the same way you do with what I taught today with the fair value gap. If you're bullish and market trades higher and trades back down into the fair value gap, you want to try to key up an entry with all things being equal and it's still bullish. The equilibrium price point, or if it's a fair value gap, it's the consequent encroachment, the halfway point, or if it's a candlestick that makes an order block, the midpoint is mean threshold. It's expected to at least try to trade into it halfway. Those halfway points are important because if it can go to just half of it or fall short of half of it when you're bearish, or go down to half of it or trade just above halfway and then go higher, it indicates a signature in terms of strength of the move. It gives you that little bit of detail to say, okay, yeah, I'm not only am I on the right side of the marketplace, and it's probably going to start moving in my favor, but it's really going to move in my favor because it couldn't even trade to the midpoint. You see what I'm saying? It's diametrically opposed contrast to what I was saying about stop hunts. You want to see a stop hunt where it goes against your direction, because then it really gives you the indication that it's going to move a lot, because now somebody has been unseated, and the only people that do that is the smart money. The smart money that will capitalize on someone else's missed opportunity, and then they ride the longer run higher or lower. Well, it's different when it comes to order blocks. You want to be able to see it not trade to the midpoint or mean threshold, but you allow for it. But your stop loss has to be outside the parameters of the order block. In this case, we have this up close candle here. If we can trade up into it, like in here, where it does that, mean threshold measures at 17,678.75. What's the high of that candle right there? Holy shit. What's the chances of that? Right to the tick. But this order block here, there's a certain caveat that needs to be applied to this. What is that? Volume imbalances. And what is a volume imbalance? A volume imbalance is any time frame where you have two candles immediately right next to each other. Now, these form with bullish price runs when it's buy side delivery, or bearish runs when it's sell side delivery. That means movement higher or lower. Taking the wicks out of the equation, because that's not what we're referring to when we're talking about volume imbalances. A volume imbalance is the difference between the candle that you're looking at and the one prior to it. Okay, so it's only a two candlestick or two subsequent immediate candles or time intervals that have a measurement of the open or closing price that do not touch. See that? The wick could come all the way down into this area here. So it could eventually be viewed as it's overlapping. And the wick on this candle could go all the way up to here. But my eye and I'm training you as a student to look at that separation between the bodies, because the majority of the volume of trading is done inside the body of the time frame that you're measuring. But this is a volume imbalance. So what you do is you have to incorporate this little range in price action. That has to be factored in your analysis. Now that might act as one more instance where you can trade up into it and then I could add another partial for a pyramided larger position. Or it could be It's going to trade up to that, and that's my exit. Or it could be I have to use this as that's my third PD array, and I'm bearish. So now I have to put a stop loss above this. So where would the stop loss need to be? It needs to be above the candlestick's high that forms this volume imbalance, which would be this candlestick right there. This candlestick need not be a swing high. It could be another high over here. And it wouldn't look like you would pick that candle, but it's the same framework I use for what? A fair value gap. So it shares similarities and characteristics for managing and employing it for entry, partials, and now I'm introducing how to use it for stop management. So if you're using this as an order block, there's nothing wrong with that, but you just can't just say, well, that's my one trick pony and it answers everything for me. No, your entry needs to be inside that candle's range, yes, but you also have to define the risk because now you have a volume imbalance that's inside this candle here, right before this 2 consecutive candles, but we've learned that this is not important because this one's the entirety of the range. And let me say it slower and simpler. This up close candle is not relevant in terms of defining a order block. This candle's high is above this candle's high. So we don't need to even refer to this. So that's why I measured that range with the box, showing you that up close candle is the order block. It does trade up into the volume imbalance, but that volume imbalance can do what? Volume imbalances, you have to be what? Flexible. They can pass through them and be used multiple times. So because that is there, you have to define the risk with, okay, what's the candle that creates that volume imbalance? The high end of it. It's this candle. So your stop would have to be where? If you're going to use that as your entry, your stop has to be above this candle's high by 1 tick. So if you have a volume imbalance inside of your dealing range, in the time frame and time frame that you're trading off of, you have to extend them to the right because they will absolutely have an influence on price. How do you use that? With managing a stop, you have to factor in the fact that, yeah, price should only go into that volume imbalance, but the rules for using it is you have to allow for static price action. Remember, it can color outside the lines, especially during high impact news driver days like today was. All right, so now we have that fair value gap right here. If you're using that as your entry strategy or if that's your model, it overlaps with multiple things here. It overlaps with these consecutive up close candles prior to this rotation lower and that shift in market structure below that low there. So you got to go back inside all this price action here. Where's your up close candle? You can't use just this one because you're not getting the full picture. Because if you're demanding it trades all the way back up to the low of that candle, you're going to miss trades. The up close candles that are in succession here, one after the other, we have the high and the low. That is your range. In that range, you grade it. So we have the up close candle. We're not measuring this low here. Why aren't you using that low, ICT? Because it's not an up close candle. And it's the time frame we're using here is the 5 minute. Why am I using the 5 minute chart? Because it's a high impact news driver day and you're not allowed to trade with anything less than a 5 minute chart on a news impact event that's high impact. So this up close candle, that is the low end of your bearish order block. And then the high end is where the last up close candle, its high is. In an ideal world, just like the same logic when I'm using my fair value gaps, okay, if I'm trading inside of a buy side imbalance or sell side inefficiency, the scope is the same. Ideally, I want to see a sell form between the low and mean threshold. That's the ideal, if you want to call it, optimal area of entry inside a range that is an order block. Can it trade all the way up here? Yep. What happens if you enter in here and it stops you out? You just took a trade prematurely and you wait and see, does it give you more indication that it wants to go lower, but it needs to leave the premium side that makes this range. So if it goes up there, you're gonna have to wait for it to make a low, break the low, and then the next inefficiency after that, because then you'll have what? A market structure shift inside the range that acts much like what? A dealing range. So your order block is what? It's a dealing range. But it's very specific with this part. We're going to take this range here from the low to the high, halfway point, that little area here, that's a sweet spot. That's your point of where the best of the best entries are going to form. So in this range here, what do we have? Well, we have a breaker. That's in the lower area too, lower half of the order block range. We have the fair value gap here, and we also have the optimal trade entry. How many things are there saying that this is going to go lower? Multiple, right? When do you use the last up close candle before the down move in price? All right, so when you have a price run, okay, you'll have a series of up close and then maybe 1 or 2 down close candles, and then you'll have a down close candle right before your last up close candle. Okay. If there's a break in this, for instance, let's say this candlestick right here was a down close candle, then I would have used that candle as my bearish order block, and none of this down here would have been a factor for it. But if you ever have a series of immediate consecutive candles, you have to define the range that all of those candles make. Divide it in half, divide it in quarters, and the best setups are going to form below mean threshold, which is the middle of the entirety of the multiple candlesticks that make up my ICT bearish order block. Also, the importance of, if you're buying down closed candles and you're treating them as a bullish order block, you absolutely do not buy a down closed candle that's outside of the range that just broke. Okay. Never, never, never do that. Okay. Because you don't have the experience to know if that range being broken to the upside is going to be sustained. You don't want to do that. So what you want to focus on is this. All right. In terms of price, generically speaking, if you think that the market is likely to get up to, say, here, okay, and we traded and now we created a dealing range. In this run here, that's your dealing range. Splitting that in half like that, where is the ideal entry points for a order block? Is it down here or up here? You want to see a down close candle in the upper portion of this range right here. So it would be like this. In that area, that's your area where you would look for a down close candle in here. Caveat, if there is a fair value gap on the time frame you're looking at in this range or the lower half, you do not buy a down close candle in the upper portion because it won't hold. It will drop down and reprice to the inefficiency that many times will have a order block associated with the fair value gap. Those two together will be confluence and you're in a discount here. And then you can reasonably expect to see the market do that.